reminder that we love questions from the audience, so you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. Thanks for meeting us for coffee. Watco Logistics makes supply chains simple. Whether it's rail, road, river, ocean, or intermodal, they manage your supply chain with efficiency and care. From heavy haul trucking to e-commerce fulfillment, they tailor solutions that fit your business, no matter the size or the complexity. Watco combines smart technology with real human insight to keep your cargo moving and your operations running smoothly. You can learn more about their full suite of services at watco.com/logistics. Good morning, everyone. Thank you so much for being here. I have been looking forward to today's episode for a couple of months now as we've been planning and putting this together. Have some of my favorite guests back on the show, have a newer face on the show who was also a guest on the podcast not too long ago. So it's going to be a really great conversation. A few announcements before we get started. Number one, we just ran that commercial you just saw for Watco. I want to give a huge thank you to Linda Patterson and her team at Watco. We are wrapping up the end of our 2025 sponsorship for the podcast. It was so much fun collaborating with that team. And I hope that everyone has got to learn a little bit more about Watco Logistics through the last 6 months of our collaborations with them. And so huge shout out to them for being a great part of this show. Podcasting takes a little bit of work. And so it's nice to have partners to come alongside you to make it happen and make it possible. And with that said, we are opening up conversations for podcast sponsorships for the 2026 year. So if you think that your company would be interested, feel free to reach out to me and get more details. We have some packets with some information, and we would love to talk to you guys about what that looks like to be the partner for the Meet Me for Coffee podcast. Also, Manifest, the Future of Supply Chain, is the huge industry conference that happens in Las Vegas every year in February. We're I think it's actually exactly a month away at this point. We're down to the 4 weeks before. So in the comments of the show, I've already put in a link to save you $200. It's probably going to be one of your last chances to save some money on this show. So make sure you don't wait till the last minute. It's $700 cheaper than your on-site registration. So go check that out. And if you guys are going to Manifest, let us know in the comments, because there's probably a good community of people listening here that are all going to be heading out there too. We'd love to start the networking a little bit early through this show today. Okay, last reminder is that this is designed to be a live podcast so we can have live conversations with live questions and live audience interaction. So we would love to hear from you guys. Even if you guys are just here listening, you're ready to hear these experts talk, let us know you're here. Say good morning, say hi, ask questions. And also, this isn't just us talking, at you guys. We believe that there's a lot of people who show up to our shows that have valuable insights. So leave your own thoughts and your opinions in the comments today, because other listeners could benefit from those and what you guys are seeing and experiencing as well. So I'm going to remind you guys a couple more times throughout the show to leave your thoughts in the comments. That's all I have to say today. So without further ado, I'm going to go ahead and bring in all of our expert panelists this morning, and I'm going to let them take over the majority of the talking for the rest of our day today. So I'd like to welcome in Ken, Aaron, David, and Jason. Good morning, gentlemen. How are we doing?
Well,
doing good.
Doing well. Good morning.
Well, you guys are all here. Thank goodness. We're all healthy. We somehow managed to, well, at least we've either already gotten over sicknesses or we're all able to dodge it enough to be here today. So I appreciate that. Luck is on our side. And I'm going to start by letting you guys introduce yourself. I'm just going to go like a circle on my screen. That would be Ken. You're right to my right. I'll let you start.
I'm sorry, you cut out a little bit. What was the question?
Oh, sorry. Can you introduce yourself?
I sure can. I'm Ken Adamo. I'm Chief of Analytics and General Manager of the Shipper segment here at DAT. I've been in and around the industry for over a decade at this point, and I've been at DAT for over 6 years. So thank you for having me.
Absolutely. Aaron, I have you on my screen next.
Sure. I'm Aaron Terrasas. I spent the past decade and a half working as an economist at a variety of places, the U.S. Treasury, Zillow, Glassdoor, and most permanently for this conversation, I headed up economic research at the now defunct Convoy.
Awesome. And what do you do today, Aaron?
Yeah, I'm an independent economist, kind of do consulting work, also teach at the University of Washington.
Yeah, and I really appreciate your work and your contributions. So definitely make sure you guys check out his the work that he's publishing too. Okay, I'm gonna zigzag. David.
Yeah, David Spencer, I serve as the Vice President of Market Intelligence at Arrive Logistics. Been in the industry in transportation and brokerage side of things for about 15 years. Really focused on roles around data, pricing, and how we're deploying some of our analytic tools into the business to make the most of predictive models. But also spent a lot of time thinking about what's going on in the freight market, talking both internally and externally about those conditions, how it affects our business, those that we work with, and how best to navigate those conditions. So, excited to be here on the show today, Samantha. Thank you.
Absolutely. Jason?
Hi, everybody. Jason Miller. I'm a research professor here at Michigan State. Been in the trucking space about 14 years now. So, David, you got me beat by 1 year. Focus a lot on employment dynamics, pricing, and whatnot, though most of my research is actually in the safety area.
Awesome. Well, thank you everyone for being here. And if anyone has attended our previous panels, we do this every 6 months, kind of just to help people prep for 2 quarters of planning, thinking ahead and kind of helping align their business goals with what may or may not be happening in the economy and the freight markets. Everyone except Aaron has been on this panel before. Aaron was a guest on our show this year, and I thought he'd be a great fit for the panel, so brought him in here. But either Jason, Ken, or David was on our panel either in January and July, because we do this every 6 months. So I have to kick this off by asking us to go backwards for just one question here at the beginning to kind of revisit the last time we made predictions or had thoughts on what we were expecting for 2025, specifically the second half if we go back 6 months. So I'll open that up to you gentlemen to say, if we're looking at a quick prior 6 months, what came about as you expected, what surprised you, and how did your predictions play out? And I think I'll kick that over to David, because David, I think we had you on for sure in July.
Had me on in July. Just thinking back, trying to review the notes from where our outlook was here mid-year. But, I think mid-year we were still kind of trying to unpack and understand how the whole tariff situation was really affecting demand and understanding just kind of the initial phases of what was going on with the regulatory enforcement environment, right? I think we had started to see English language proficiency had just been kicked off, I think, in the weeks prior to our conversation. And really unsure about, okay, here we're looking at a weak demand environment, uncertainty around when we were going to see sort of demand sort of come back. And then now looking at capacity sort of also starting to be under scrutiny and start to go on the decline. So I think us looking both back at downward trending demand and downward trending capacity, I think we were mostly in the camp of stability, but spot rates didn't quite get as high as I think where we were expecting them to. Although in December, I think getting up near 10% year-over-year growth according to DAT there. I think we might have gotten a little bit lucky by accident on where by year end spot rates would get to in that forecast, whether or not we got there on a straight line in terms of what we were expecting.
Sure. Jason?
Yeah, so I would say, just as David said, last year, midsummer, we were still trying to understand where the tariff piece was at. The piece that was missing was the government data that we had at the time was not really conveying how much capacity was leaving. I know I just shared on LinkedIn yesterday. The administrative record data suggested we had a lot more capacity exit in the dry van space in 24 and all through 2025 before we've had any type of sort of enforcement situation kick in, because that data is only through June. And so had we had that data at the time, I would have felt a little bit more comfortable saying, things are going to tighten simply because supply was exiting. Again, we didn't know that really at the time. Yeah. I think as David said, spot rates, I had my adjustment of DAT's data has it up like 9.5%, 10%, 9% year over year in December. But up until then, it's like up 1-2%. So it's nothing really special. From my standpoint, demand environment is at best weak growth to neutral volume right now at the moment. Likely going to be down a little bit in Q1 because we did have some robust activity last year with front loading. But supply is down enough that things have tightened. For me, the biggest question now is, do we see spot rates stay elevated really into February? Like mid-February is kind of, for me, the cutoff, because that'll sort of give us a sense of where this year is going to start out at and how carriers are going to start to behave.
Yeah, Jason, a quick comment. I had just gotten a subscription to an economic newsletter I subscribed to, not freight related. I just got an article this morning about the job revisions that they're expecting, but they also called out that manufacturing and transportation are driving the vast majority of U.S. job losses for 2025. And so it looks like we're starting to kind of be able to analyze that. And they said it's been on decline since February of last year in that sector. Transportation is broader when we're looking at that, I'm sure, not just trucking, but that aligns with what I'm seeing other non-industry economists start talking about the transportation sector.
Yeah, no, and the thing is, too, is manufacturing is just doing quite poorly right now. We just had ISM release their December PMI data. Yeah. And the big thing that I'm just taking away is we're actually entering, from a manufacturing standpoint, 2026 in a worse position than we were entering 2025 in. And so that's the one thing, is we're trying to sort of game out demand scenarios. We were entering 2025 actually with a lot of tailwinds in place. We don't have quite the same tailwinds going into place this year, in large part because we have the tariffs in place, and we can see with ISM, especially surveying big manufacturers that are much more export and import intensive than your average Joe's fabricated metal shop. They're struggling right now. And so that's going to be, I think, the big question this year is, can demand start to grow enough that it essentially, with supply being tighter, do we see persistently higher rates? Or I think, as Ari has brought up in the comments, is this a situation where really weather has been playing a super seasonal role, to quote Bascom Majors in his assessment in 2025?
Yeah. Okay, we're going to get into some of those topics more. I'm going to go to Ken next. Ken, we had Dean on from DAT, I think, in July, but I think you were on our January panel. So just give me a quick recap of what surprised you, what was as you expected throughout 2025.
I was surprised how bad it was until the last 3 weeks, to be honest with you. I think we all expected a little bit more macro inflationary pressure in the truckload market, which just didn't happen. I think Jason hit the nail on the head that we just didn't see the demand, and supply didn't exit probably as fast as we thought it would. I'm a huge fan of alliteration, and I heard like the compliance crackdown is what's driving rates these last 3 weeks, when I think realistically it's probably more just the fact that Christmas and Thanksgiving, last I checked, happen every year. I think I was personally really starting to worry about how peak was going to look this year as we marched on from Thanksgiving, and it seems like it was a very short and sharp end to the year. So I think the year started really strong and ended really strong, and it was pretty crummy from late January until early December. So kind of a boring middle of the year.
Were you expecting that another boring year, or did you think at some point that might change?
I thought we would actually see more. Honestly, I think I think the technical term is crapping the bed. Had we not like crapped the bed on a tariff policy and like the taco trade in Q1, I think we probably would have seen that demand. Right, we saw a reinstatement of the tax cuts. We were expecting more interest rate cuts earlier in the year. Like most of those interest rate cuts happened in the tail half, which weren't as you don't have much time to run with the tailwind of that. So I think we were poised coming out of a really strong peak duration last year in January. I think we were all feeling optimistic about our predictions, and then I don't know that anyone expected a conservative-led Congress and executive branch to go anti-free trade. I just don't think that was what. I'd love to find the person who predicted that.
Who had it on their bingo cards? If someone had it, then do we need to know? Because we need
nobody had it to the extent for certain goods, but especially it was the uncertainty. That I think was the key thing, is just nobody knew what was going to happen. And right now, nobody knows what the Supreme Court is going to do.
Yeah,
and so
we're kind of still in a similar situation of uncertainty heading into the beginning of another year. So, Aaron, I did not have you on the panel in the last year, but I would still like to get your thoughts, even just on the broader economy. Like, what kind of surprised you, or maybe was as you expected throughout the course of 2025, if you think back?
Yeah, I think back to some of the economic outlook talks I was giving at the start of 2025. What certainly surprised me, I'd say, at least through mid-year, was what appeared to be the strength of the labor market. Now, obviously, we know better, but there was seemed to be this massive disconnect between all of the anecdotes and some of the soft data around labor market sentiment, and then jobs report after jobs report that just kept coming in, exceptionally strong. We now know, of course, that a lot of that was revised downward, but I still think with kind of the changing immigration environment, the downward revisions are perhaps not so worrisome, because break-even payroll gains, kind of the number of jobs we need to create to keep the economy stable, that has come down as well. So as much as the payrolls have come down, if we're still creating 30 to 50,000 jobs a month, that might be enough in this environment. So I'd say that's one thing that surprised me. What didn't surprise me, I'll say, is kind of what I call higher but not high inflation. So what inflation was running 2.5% to 3% for most of the year. That's higher than we're accustomed to. Certainly not explosive. This is not stagflation. This is not like the 1970s oil shock. But it is a very different environment than we're accustomed to. And the reality is, I think for all of the fears around tariffs, consumer goods are a small part of the CPI basket. Housing, energy, those were all deflationary this year. And those are, upward of half of the CPI basket. And so I think we just need to keep in mind that tariff vulnerable goods, are a small part relative to those big pieces of inflation. Just one last comment on the uncertainty point. Some of the small businesses that I've met with here in the Pacific Northwest, kind of one of the comments I've consistently heard over the past 2 months is that April and May and March, they were paralyzed by uncertainty. They still have that same uncertainty, but their bosses just start telling them, CFOs, kind of planners, they just need to make a decision. And so, to devil with the uncertainty, they are moving forward with some degree of planning. And so I think that really frames my outlook for 2026, is that the uncertainty is still there, but people are working through it.
Yeah, I like that. I think that we see that a lot across supply chain and logistics too, where at some point we can all pause, but we can only pause for so long before decisions have to be made and businesses have to keep turning profits and producing goods. So I think I think the pandemic was a good like prep round for what we've experienced in the last couple of years, where we all feel a little bit more comfortable now just saying we got to do something, put a plan in place and move forward. We definitely had more paralyzation for longer periods of time in the greater periods of uncertainty we had prior throughout the pandemic, I think. I also want to say thank you and good morning to Ari for putting some questions in the comments, and to Nick. Good morning, Nick Spears. Thank you for your questions. We're going to get to these actually probably here in just a second. As we kind of move, thank you everyone for recapping 2025 and kind of setting the stage for a conversation around 2026. So my next question, I want to kind of transition over to more the economic side of our conversations. We usually talk specifically about like things like truckload rates, but we also talk about economics because we know that the economy is what drives freight. So, gentlemen, I'd like to ask what you think we should be watching, looking for, paying attention to when it comes to economic data points or any type of headlines in the next 6 months going into 2026. And whoever wants to also keep in mind the question that Ari had asked first. He said in the S&P Global PMI and somewhat in the ISM PMI for December, there was a noticeable gap between production and new orders. S&P Global's economists talked about the Wile E. Coyote impact, making things and going off a cliff in the process. Aaron and everyone else, what do you make of the PMIs, and what do you think this says about truckload and less than truckload in the next 3 months?
Yeah, so I think the things I'm looking at the most for, and unfortunately with the government shutdown, we are still waiting for a lot of data that we'd love to have. But new single family housing permits, not the starts. The starts are so volatile, even seasonally adjusted, but the permits are a lot smoother. Those were down about 10% year over year as of August of last year. This is why I'm saying that feels like ancient history. But I'm looking very closely at that to see if that tips up. It's going to be a rough year for construction of apartments. We just completed the most multifamily units that we have in decades, and we're already seeing rental prices stagnating in many markets. So it's going to be a bad year for building apartments. We can already just bake that in. If you're a carrier that hauls a lot to those type of job sites, it's not going to be as good of a year as it was the last couple. And then, as Ari mentioned, the manufacturing PMI data. I look a lot at ISMs, especially new orders. It's about 1.6 standard deviations below the mean that it was from about 2012 to 2019. Just translating to that is really weak. And we're not, and this is where I'd say it, if you looked December last year, it was positive. January, it was quite positive. It was starting to sort of indicate manufacturers were really seeing things better. And then that just really declined starting in February. And I think we know what to point to with that, with it being the tariffs. And so to me, those are the big things I'm looking at from a demand side. It's construction, it's manufacturing. We can look at fracking. The Dallas Fed Energy Survey is one of your best resources for that. And it's bad right now. You're not going to see more oil wells getting drilled this year. And so that's going to be another headwind. Commodity prices, not so great. Farmers getting the bailout that may help a little bit with equipment purchases if we overpay them like we did in 19. 19 was a surprisingly good year for ag equipment, even though commodity rates were low. But in general, there's just not that much to get excited about that isn't a data center. And I think that maybe not this year, but over the coming years, you're going to start seeing a lot more pushback against the data center piece from across both sides of the aisle. You're already seeing that with Bernie Sanders and Ron DeSantis, two individuals that I don't think could agree to the color of the sky, starting to talk about concerns about what data centers are doing to electricity pricing in certain markets.
Yeah, and it's not necessarily a data point I'm watching, but more so certainty around the tariff environment, whether that's a North American trade deal or more certainty around with our large trading partners, and what that could do to, stimulate investments or money that's been sitting on hold on the sidelines, right? I think if I'm looking for a demand boost this year, I'm looking for that tariff certainty that could spark things that potentially could turn this ship around. I mean, Jason, I know we've had discussions about this, that, you know, even if you get that, you're still looking at a window of a few months at least before that jump starts things to get going. But, you know, to me, that's what I'm watching for, to really see, you know, freight demand move in the direction that's going to stimulate the rate environment that we're all looking for.
Yeah, I think that something I heard is this has been a little, I guess, quieter in the background. At the same time, we're creating all these tariffs that are making certain industries really difficult. There's been a lot of exceptions or even incentivized kind of tariff agreements around like data center materials and the construction of them. And that's why we've seen like such rapid growth over the last couple of years in that space. So I feel like that kind of proves what having a degree of certainty can do in a certain sector when we know what's going on and where the current administration stands as in its support of certain types of manufacturing and production. So I feel like that's been like kind of an odd outlier that we could look at, like the contrast between how everything around AI and tech and data centers and construction has kind of been performing juxtaposed to other verticals within manufacturing.
Well, and within data centers, the key thing, it's part of the things that go into them. It's the GPUs, it's the computers that are exempt so long as none of this stuff comes from China. That's still tariff.
Yeah.
But the actual materials to build the data centers, those are affected. And so that's where, but right now the attitude is we can just pass those costs, you know, on as we move forward.
Sure.
And so that's where, you know, you get this juxtaposition versus other sectors like single family housing. You have the National Association of Home Builders saying, please remove all tariffs on materials needed to construct houses. In the North, we rely a lot on Canadian softwood lumber. It's now subject to, I believe, about a 30-some% tariff.
I can jump in with 2 data points that I'm watching for 2026. You know, I think if you listen to a lot of the retailers, they'll say that this holiday season was, you know, kind of not stellar, but not a disaster either. Probably stronger than they had anticipated. Kind of low expectations going in, and you know, it speaks to this old adage that you should never short the U.S. consumer. The consumer comes out, U.S. consumer comes out again and again for the American economy. I just have to wonder how long that can hold up. So one data point that I'm really watching is consumer debt and delinquency. We know a lot of holiday shopping was on credit cards this year. You know, starting, I guess, tomorrow, we're going to start seeing student debt, kind of wage garnishments. And so I think this is going to be a real strain on kind of some consumers. Obviously, kind of higher income consumers have been kind of driving a lot of that spending. So yeah, consumer debt and delinquency. The other metric that I'm really curious about is all of the alternative measures of unemployment. Unemployment is still low. It's, you know, roughly in the bottom quintile historically. So it's still very good. But, you know, I worry that this isn't your father's labor market, that there are all of these other ways that the labor market is showing slack. For instance, kind of you look at kind of part-time employment, self-employment, kind of you look at labor force exits. These are all of kind of a variety of ways which the labor market adjusts and people kind of are not working without necessarily an increase in the unemployment rate. So I'm particularly cautious about reading too much about in the unemployment rate right now.
Thank you, Aaron. And Ken, we've made it around to you.
I think the benefit of going last with bona fide economists going first is I don't have a lot to add. I mean, I think to get things moving in the right direction, I agree that like housing needs to get picked back up, and that's probably most in my simplistic brain tied to interest rates. Just because I think about how most people behave, and right now there are a lot of folks sitting on their homes because they're locked in at rates that are significantly lower than what they're able to go out and achieve in the market today. I've been focusing a lot more in the last couple of months, to be totally honest, on within our industry things that are changing, like broker financial responsibility and things like that. I think those have probably more of a potential in the short term. I think the next couple of quarters to move things on in our market specifically. But it'll be interesting. I think the only thing I didn't hear that I'll add specifically is if the Supreme Court rules against the Trump administration on tariffs and they need to be refunded. I think that will be super fun to watch. I think it'll be absolute and total hell on all transportation managers up and down the industry, but that in and of itself is generally positive for our industry as a
Sure.
whole. If we have to start, because I totally agree with the folks who say even if Trump loses in the Supreme Court, there will be a lull, which I think shippers will just force as much as they can through the pipe, but they will try to go through alternative methods post hoc to get the tariffs back in place. So that would be a really interesting ride, I think, for 2026 if that
Could
happens.
it potentially like be a repeated cycle of 25 if that happens, where we have just as much now? What are we going to do? What's going to stick? What's not going to stick? And does it cause just as much uncertainty and stagnation?
I don't know. I think if the pipe opens, even if it's for 2 or 3 months over the summer, I think you'll see just an absolute bonanza of stuff coming across. Especially if interest rates continue to come down, right? Remember, inventory carrying costs are very much tied to interest rates, and shippers want to hold less inventory whenever interest rates are high because they're paying. That's impacting their working capital and short-term cash flow. So, yeah, I don't know. It's unprecedented times. I mean, it's certainly in my lifetime, in like the kind of narrow window that I studied in college, like most textbooks did not study a time when the administration was fighting with the high court on tariff policy. So I don't know that there's really a precedent for a lot of this, but I think, again, it'll be fun to watch. And I think, again, any volatility, right? If you're looking at like the broker exposed, so like the spot in kind of near-term contract market, volatility is bullish, period, end of story. Like I've yet to see it. David might have a differing opinion on this, or he might agree, but I don't know there's any situation where volatility is a bad thing for spot exposed participants in this market.
Ken, would you say something? Oh, go ahead, Aaron.
This has gone a couple of times. I have a little bit of perhaps a different perspective on the housing market and the direction that's going. But I think we've become so accustomed to this idea that housing construction is in a deficit, that we're in a chronic housing shortage. The reality is, if you look at the demographics beyond interest rates that drive housing demand, the past decade or so, we've been in this period when older generations have not downsized, younger generations kind of are in kind of peak household formation and housing demand growth. Typically someone downsizes, is forced to give up independent living in their early 80s. Baby boomers are just about to hit that. So I actually think we're about to hit a point in the housing market where we suddenly start to see more housing supply come online, perhaps calling to question some of these chronic housing shortage hypotheses that we've been living in for 30, 40 years. So it's just one caution about this idea out there that we're in a pervasive, permanent structural housing shortage that will never end, and we need indefinite home construction. That could shift radically in the next 5 years.
Well, and I think building on this, the other thing, we have to see hiring rates. I mean, the job opening labor turnover survey does a good job tracking this. One reason people aren't moving as much is companies aren't hiring as much. Like the hire rate right now is basically mid 2010 levels. I remember graduating undergrad at that time. It sucked. That's why I got a PhD. There was no opportunity cost at that point in time. And so I think that's the other thing is we've got so many things that need to unlock themselves. And that's why, as I look out there, my statement to every trucking company listening to this that's seeing spot rates really run up in December is caution, because the macros are not necessarily in the favor other than the supply exit. But if the demand steadily to increase is not there, then we all know how markets work. Markets are very efficient. Rates stay elevated for the next couple months. Carriers will start to add capacity that comes online in 6 to 9 months. And so that's, to me, the big thing is we're all hinting that there's a lot of key, almost moving battleship type of things that need to adjust themselves. And that desire for economic stability that we all want, that is just unlikely to be here this year because of the Supreme Court and the IEPA ruling, and then what will come after that. The one thing we haven't mentioned is if there would be those magical $2,000 tariff rebate checks, I mean, that'll goose retail demand like crazy for 2 to 3 months.
Yeah.
And so,
well, what about the situation in which I'm not sure how likely it is, but IEPA is not, like, none of the tariffs are overturned. They say everything's going to stay how it's been. We maybe have some materialization of these checks because the tariffs are staying. And then we're also supposed to have a pretty, people are saying it'll be a good year for tax refunds and benefits. So I mean, we could also potentially have, that would be like on the optimistic side of the perfect storm, I guess.
And then what we will see, every importer will raise their prices. If demand, the thing that really helped keep the price increases for a lot of imported goods under control was demand was so bad this year.
Sure. I do agree with that. And with the inflation numbers too, you know, Aaron mentioned, like, a lot of economists didn't see the impacts of tariff driven inflation that we thought we would see, but we also have heard from a lot of manufacturers that they're not going to pass through those costs yet because the demand was weak for their sectors.
Well, and I think the other thing too is where we see a lot more evidence of higher prices is more in, I'm going to call it producer goods. So I'm going to pick an industry I've got to do exec ed on this week. I won't name it, but prices that they're charging are up 7.5% from where they were last year. That's even more than prices were up in 2018 in this sector. Except the difference is demand 2025 was actually lower than demand in 2024, whereas in 2018 it was gangbusters. And so I think that where we've seen is for more consumer-oriented goods, we haven't seen the price increases as much, but more for producer goods.
Sure.
German machine tools did not become cheaper. And so that's where we've seen manufacturers eating more of those costs. And therefore, I think that's also kept the demand side somewhat cool. And so my question is, just as we move into this year, anything that starts to make retailers and wholesalers think demand's going to pick back up, they will raise prices. I've talked to at least a couple companies that have already said, March 2026, we're raising our prices because those tax refunds should be starting to hit. So they're already planning.
Yeah. Okay. Let's transition now into, Ken kind of kicked us off, but my next question was going to be specifically around like the freight markets. And I want to talk about what we're looking at more now from the supply side, more around trends or regulations that have been going on throughout 25 that are carrying into 26 that could be the triggers to impact the 2026 freight markets. And this is also an opportunity for us to start talking about some rate predictions if you have them and you would like to share them as well. As we move through this section, I think we have a few comments that could be, or questions that could be addressed in here. Thank you, Dylan, for asking a question around construction. He said, given freight forecasts that suggest capacity tightening and rate volatility in 2026, what long-term transportation risk management strategies should construction companies adopt to protect project margins and material flows? And then we also had someone ask, how much capacity is sitting in carrier yards ready to launch versus new purchases, etc. So just keep those in mind as we go through our conversations around the freight markets. And if anyone listening has more questions to add, please go ahead and drop them in. I promise we'll get to them. I'll make sure we bring it up when it fits in the conversation. So add your thoughts anytime.
I mean, on the capacity side, I'd say looking at the administrative records that the BLS produces, looking at the non-employer statistics the Census Bureau produces, I'd put dry van truckload capacity down 3 to 5% from where it was last year. That 5% probably is the high end. That would include some of the expanded enforcement. We certainly don't have freight demand overall down 5%. Again, we saw that big seasonal tightening here in December. The one caution I'm going to have with that, I was just in the background calculating what off of DAT's data, what we saw in 2022 December, because that was when we also had a polar vortex, terrible December weather. And all the rates went up pretty darn strong. Like dry van rates were up like 12 cents a mile. Now that's not the 23, 22-ish cents a mile we just saw adjusting for fuel. But still, just for perspective, and those rates came plunging down then in 23. So, to me, that's on the capacity side. The question I have, and this ties into the one comment, is payrolls, dry van over the road, they're down about 45 to 50,000 from the peak in late 22, early 23. That means a lot of drivers lost their jobs. Many of these individuals legitimately have CDL. We're not talking the non-domicile concerns or things like that. If this market is doing well, and Samantha, building off your comment off of Joseph's Substack, I'm guessing you were reading earlier today. you've got individuals who are losing jobs in manufacturing. If trucking's strong, that's one of the biggest sources of folks that enter trucking is they lose a job, they decide they're going to have a career change, they go get the training. This is not an extensive process where it takes years. It's a matter of a few months, and they're going to be able to drive. You also have a lot of people who lost jobs who aren't driving now, who could hop back in with a little bit of time if that is a better job opportunity. And so to me, the one caution I have for everybody is I think with the focus on non-domiciled CDLs, immigrant truck drivers, et cetera, it's caused folks to lose sight of the fact the vast majority of truck drivers are American citizens who have obtained CDLs, and I'm going to call it the traditional manner. And so people can enter this sector. It's not like it's going to take 2 years to add capacity if rates stay high. And so for me, I think it will be, capacity is going to be down year over year, probably for almost the entirety of the year, because we're not going to add back 5% capacity. That's way too big of a number to add in a year. And so again, I think that rates will stay certainly elevated from where they were last year. December was up 9% year over year. To me, a higher end prediction, and this is kind of very optimistic, is up 15-ish% year over year, maybe to the exclusion of the December reading, because that was such a strong reading. Maybe that's only up 10%, but that's a high end forecast. I don't look for anything like back half of 17 in through 2018, where we had ELD mandate having at least a temporary tightening of capacity, but we had freight going gangbusters in the back half of 17 through Q3 of 18. So that's to me where there's a big difference, as freight was growing so strong over those periods. I don't see a scenario where freight's growing more than 1% year over year into all through this next year.
Okay.
Yeah.
David, I saw you nodding your head when he started that out by talking about the 3 to 5% change. So what are your thoughts on this?
Yeah, I mean, I think one of the biggest trends we saw throughout this year was the equipment ordering patterns, right? And what that means for reduction in the tractor population, right? Down for the first time in over 4 years. And the expectation is that will continue to decline with the lack of investment in the fleets right now, most likely from a reduced profit environment the last few years. Look, I think supply side, it's pretty clear, right? Supply is down. Yeah, I think we're expecting it to stay down as well. Demand's going to be the key driver of rate trends in 2026 if we see, an inflection to a large degree. But just kind of stepping back a little bit, and some of the, we've been talking about the hard data. I kind of want to talk about the vibe of the market a little bit right now, right? Because you look at what you saw in early October. Right, you saw sort of that response to that non-domicile CDL enforcement trigger some rate or early volatility there, right? It was short-lived, but as soon as that opportunity presented itself post Thanksgiving, when that weather was hitting, and I do think a lot of the rate increase in December was weather-driven. Participant behavior is a big part of what we're going to see. Sure. Not just what are the fundamental economic data points showing us, but carriers are looking for that opportunity to not necessarily price gouge, but what can they get out of these opportunities that present themselves? You're looking at Q4 peak retail season. Right after Thanksgiving, widespread winter weather hits the Midwest and the Northeast, and that's an opportunity for carriers to raise their rates and push. Right, we didn't see that early December lull like we typically see, and I think a lot of that was driven by participant behavior, i.e., the carriers resisting any kind of rate declines and pushing rates up. It's my opinion, we're already starting to see a little bit of capacity easing. Rates are going to come back down. I think it's a short-lived seasonal volatility boost. But I think that's one of my key trends for this year: increased seasonal rate volatility. Whether that's as imports, season picks up March through August, more so May. Whether that's produce or summer peak season. When you see these types of periods of either demand surges or capacity coming offline, DOT week, expect carriers to push rates up, right? But that doesn't mean we're going to see that sustained disruption, but more periods of vulnerability and increased rate volatility for sure. So I think our forecast calls for somewhere in the 8 to 10% at peak year-over-year growth. we still believe with a demand boom or something unforeseen, it could definitely go higher than that. But right now, that's sort of our stance, is that you're seeing greater routing guide sensitivity proceed year over year. And that's our opinion of what causes these instances. You see routing guides start to be challenged. That creates spot demand and the opportunity for rates to be pushed up. And when you see that increase in rejection environment occur when it's supposed to occur this year, expect rates to go up. It doesn't mean there will be a sustained disruption, like I said, but more volatility around those seasonal periods. Just to kind of wrap, Dylan Jarvis, that's an old Arrive name here, so I had to give a shout out to him in the comment section. Just to kind of try and answer his question a little bit, I think depending on your equipment type, Dylan, in the construction environment, if it's a lot of open deck, you're probably a little bit less volatility in the open deck space that we've seen over the last year, a little bit more capacity availability. So probably less concerns in that space. But, like I just kind of said, we're going to see typical seasonal patterns, right? So think about a more like a typical seasonality, type year here, navigates through those periods, trying to be flexible when you can. But for the most part, open deck's going to be less affected by a lot of what we're talking about here with the capacity that we are seeing today.
I want to jump in quickly just to add, like, I really appreciate you bringing in the perspective of, what you called vibes there at the beginning. But, we have a lot of people who live and breathe this industry every day, and a lot of them are probably listening right now. So this is your opportunity to share what you guys are experiencing or your thoughts on the last couple months. But I had the opportunity to talk with several carriers of decent size throughout the last couple months over the holidays. And they told me that, a lot of them said no amount of money can convince our drivers to not take an extended holiday vacation right now. And so I had fleets of over 150 trucks, literally with 60% of their driver force take 2 weeks off throughout the holidays. So like we had a large amount of people take breaks. And then depending on your national origin, the New Year was also a big holiday. So the beginning of January, even here, starting off is a big deal for a lot of our immigrant population in the driving space as well. So they still take extended breaks. And then we had the normal peak stuff, but I'm curious if anyone has insights on how much we staffed part-time and temporary labor for the holiday seasons. Because I heard overwhelmingly this year that there was a lot of delays and dysfunction and multi-day backups at DCs around e-com and small parcel and things of that nature that we're trying to move out of distribution centers. So there's a lot of, anytime we have all that operational inefficiency, it always pushes back into increased tender rejections or increased temporary spot rates, especially in certain markets. Where if you were trying to cover freight in Georgia and a truck said they were available, but they were at a certain couple of facilities, you knew they weren't actually going to be available when you needed them. And so you were seeing tender rejections happen or rates go up because of that. So I think there was a lot of like very typical peak season factors at play this year too, that went into these rate increases that we saw. And so I'm more on the side of being cautionary as well, wondering how long that disruption or these rates could sustain moving into this new year.
That's why I said February is the month that I'm looking at the most closely, is barring, again, polar vortex craziness, is if rates stay at the 229, Ken, correct me if I'm wrong, all in $229 per mile dry van. If they stay at that level through February, then we will know that the market has fundamentally turned in carriers' favor. If we're back down to let's call it 215 by February, 212, then that's going to be a sign. I think, speaking to what David said, yes, capacity is tighter. The base for spot rates has come up, but we're not in a breakout market. And by breakout, I'm going to describe back half of 17 into 18. Like that was a breakout market. What we're all describing here seems to more gravitate to a 2014 type of market cycle where rates went up. They went up nicely, but it wasn't 17, 18 type of situation.
Yeah. Ken, what are your additional thoughts on freight market trends in specific?
I mean, I think it doesn't impact the big brokers, but I do think that for the long tail, the changes to broker financial responsibility coming in place January 16th is going to be a pretty big deal. I mentioned that earlier. I think as we march into the spring, I mean, I think rates will come down. I don't think the non-domicile thing is going to work its way through the courts as well. If you remember, the rulemaking was held by the courts. And so I think that will kind of continue to progress through. I think enforcement, the DOT is arguing quite a bit with states around enforcement. Remember, these laws are enforced at the state level by and large. And so I think,
and also correct me if I'm wrong, Ken, but the states can start to kind of enforce their own rules even without an official ruling, right? Or we're at least seeing them react. I know that some states are taking different stances on this kind of preventatively in case of policy change.
Yeah, I think it's like how the government works in general, right? Like states are able to do things as long as it doesn't conflict with overarching federal policy or federal law. So I think if it was a state's policy not to issue non-domicile before, they can more than, they're more than able to not issue them now, I think. But the quabble is with the government in the federal government and their involvement with it. I mean, we've been trading capacity for a few years now, so I'm not at all surprised between the weather, the long-term, 3+ year capacity attrition cycle. I'm not surprised that we had a robust peak rate increase this year. I am surprised how delayed it was, which I think honestly plays a part in how sharp that increase was, to be totally honest. It was also a really weird calendar year this year with a very short time between Thanksgiving and Christmas, which if you're in the freight, if you've ever worked in the operation of freight, you know that the calendar is very, very important. Christmas, I believe, falls on a Friday next year, which will take a lot of that pressure off actually in terms of the calendar. So I don't know. I don't think anyone wants a supply-driven freight recovery in 2026. I think that would be pretty crappy for everyone involved. I don't think that's what we're hoping for. I think capacity normalizing, even latching onto a couple of these demand tailwinds we've been talking about, would be a pretty healthy return to normalcy in terms of market upswing. Polar vortex, I mean, that's all. I don't know. I think like some of the best advice I got early in my career is like you can work on predicting the predictable. I don't know if there's going to be a polar vortex. So
I've heard the odds are strong this year for some crazy weather.
I didn't buy my Farmer's Almanac this year. I know that weather has been pretty. I mean, if you think about it, most of the Midwest and Northeast has been dealing with weather since Thanksgiving, which is pretty rare. I mean, winter arriving that early and sticking around is pretty rare.
Yeah, I don't know. I don't know how to speak to that at the moment because we had a 73-degree day on Christmas Day, and then it was like 17 degrees 2 days later. So that's Kansas for you. I'm the central part of the country, and it makes zero sense here right now. So, Aaron, any other thoughts to add on freight markets?
No, I just one, I guess, caveat I think that I would add, this idea that kind of there is this low barrier to entry into adding new capacity once rates are credibly, durably high. I think we need to emphasize that capacity is not going to add if there's a credible case that it's a temporary upswing. There needs to be a credible long-term upswing in rates before capacity gets the add. But any new capacity that comes in 2026 is going to have a higher cost base. If you just think about vehicle costs, it's kind of the tariffs on top of vehicle costs. That's going to be a high cost base marginal capacity. And people have to be thinking about that. It's always a bad idea to add capacity at a high cost base, and I think we've seen that error in the past.
I personally think that the barrier to entry, our industry in general, has been rising over the last. I've been in the industry 7 years, and it for brokers as well, and also for carriers with the amount of technology, insurance, and risk that you're taking on now in our sector, you have to be prepared to handle. The cost to handle all of that has gone up, and so. I
but
think
not enough, right? I think that's probably the hot take.
Yeah, maybe not enough, but arguably.
I think like that's
it used to be incredibly too easy.
Yeah, I think like that's what gets lost in a little bit of especially like the FreightX rhetoric around like non-domiciled and just general kind of immigrant truck drivers is like, I think it's this false dichotomy that like all immigrant truck drivers are bad and all non-immigrant truck drivers are driving brand new equipment that is held to the highest level safety standards and maintenance, and they never speed and they never get behind the wheel intoxicated, and they always test their tire tread depth before they roll out of a warehouse.
I think our friend Matthew Leffler would tell you.
I wouldn't have had a career. I would not be a full professor in 7 years if all of these things happened. I've made my career studying variance and carrier safety, so I can attest to what you're saying, Ken.
Yeah, I mean, like if we wanted, and this is like where I think the conversation reaches like rocky ground, right? Because if you're like, okay, well, we're going to go after English speaking, which I think we all agree truck drivers should speak English. I don't think anyone on this panel is going to disagree that like truck drivers should speak English. But like also maybe like if you have more than 3 out of service violations in a calendar year, you're put out of service for 3 consecutive months, right? Like, well, I think like that would start to raise some eyebrows because there's a lot of like super non-immigrant people that are getting out of service violations who, or like, let's raise the insurance standards. And then I think like you start to get into like a little bit of overreach of like, maybe we start issuing CDLs at the federal level and not the state level. I think that would cause a lot of discussion around states' rights versus federal overreach. So I do think like the capacity pool is this rather amorphous thing that we like to talk about, but in reality, it's like still ultra easy to get a CDL. It's ultra easy to do illegal things and not get caught, because without commensurate increases in enforcement, you're not actually going to see a commensurate decrease in the capacity pool, right?
Well,
again, I'm waiting for
where the attention's coming from, that the attention is coming from that federal level, because they're supposed to oversee like these CDL schools and the, you know, how they're regulated, and they haven't. And now they're wanting to get involved and point fingers, but it's going to ultimately shine the spotlight, I feel like, right back on themselves for what they would have to do.
I think this is a study for Jason to do once the data comes in. But if I don't gamble, but if I did, like I would be willing to bet a large sum of money that what you're going to see is a rather equivalent decrease in non-ELP out of service violations during the period where ELP violations went up, because we didn't increase total enforcement levels. And so my guess is they're probably just writing fewer break out of service violations because they're not like stretching themselves any further, right? The same number of enforcement is at the way stations and on the roads. And so I think you're seeing probably not an overall increase in total out of service violations. You're just seeing the pie shift around a little bit. And then I think it becomes an argument about
I'll have to ask my buddy Alex Scott to do that. I think it ties into 2 other things we haven't talked about, but new Class 8 orders, that's something that everybody needs to watch really closely, because historically the best predictor of new Class 8 orders was change in spot rates. So if you look year over year change in Class 8 truck orders, best predictors year over year change in spot rates for just essentially lagged 1 month. That would suggest January's reading is going to be very interesting when FTR and ACT Research put that out in February. If you start to see new Class 8 orders start to rise, guess what? That means that folks are serious about adding capacity. The second is is just heavy truck sales. I just pulled the data down today because December's data just came out. They have fallen off a cliff since June. They're down about 30% from 450,000 units a year, seasonally adjusted annual rate, just to down about 310,000 units a year. So clearly up through December, nobody, the amount of equipment purchasing was at like the bottom of 2016 market levels. Mm-hmm. So we haven't seen any signs yet of that capacity wanting to come back. So that's why we just got to watch those new Class 8 truck orders. I will tell you, I can say from that, if you haul truck parts for going to Daimler plants or Volvo, and it's going to be a rough next 6 months in terms of your freight volumes. I can certainly tell you that right now.
I think I just heard that the pre-orders were really weak for the 2026 year. So, I mean, they could still put in orders heading into 2026, but I think you're right. We're going to have to watch that because the pre-orders didn't give us any positive indications of traction there.
And this ties into what everybody said. This market seemed to really turn really, really, really fast in December. And that's why I think we're all questioning, was it something other than like, is it not fundamental demand increase, or is it all of these factors we've all described came together in 1 month?
Well, guys, we are so close to time already. So real quickly, I wanted to ask if everyone could kind of give their parting words of wisdom or any piece of advice if you'd like to address a specific part of our industry, whether that be shippers or brokers or carriers, anyone in between. I'd like to just go around the circle real quick and get all of your kind of closing thoughts. I did also want to address something real quick that Mo said. He said, curious if anyone else is seeing regional shifts in freight flow heading into 2026. For example, we've seen more of our cargo volume moving toward Georgia and away from California. Do you think we'll see a broader migration of freight away from the traditional West Coast hubs in 2026? My initial thoughts to that were that a lot of the changes that we saw in supply chains throughout the pandemic and shifts to specifically Georgia, actually, but like the Carolinas and the East Coast ports and Houston and all of that, like I think that a lot of that stayed permanent. We're building a lot of new infrastructure across the country. But then I also think that we need to really hammer out, like get the finality and the certainty of these tariff agreements and the NAFTA agreements to know where supply chains can start kind of investing and sitting with some degree of permanency to know. I personally don't know that California is ever going to be as big of a player as it was prior to the pandemic, because I think we've adjusted so much since then. But if anyone has other thoughts to add real quickly, and then your closing thoughts.
I think this is a long-term trend. I think it predates this year, kind of even before supply chain shifts. And I'll just note a caution. We think about potential risks if the Caribbean remains a volatile place, as it has been this past week. That could kind of prompt some rethinking of diverting trans-Pacific trade to East Coast ports.
We didn't even get into geopolitics. It was on my list to ask, but I appreciate you bringing that up, Aaron, because we have other things going on in the world that also can have some impacts on supply chains, and that's definitely one of them. Like what a change in ports of call yet again, potentially in response to global events.
I mean, I can jump in. I think just in terms of words of advice for the year, I think I'll speak to the shippers out there. Really, I think like constant communication with your carrier and broker partners, understanding what they're up against. It's not getting any easier or cheaper to run a truck these days, right? So understanding that that mentality is what you're going to be facing when you're in contract negotiations and discussions. But that being said, I still think vulnerability to a sustained disruption remains low. So your service expectations should remain high. You can use this past 6-week period as a good idea as to who your true partners are and who's gonna give you that service offering throughout the course of this year. So use this past little stretch as a good indicator of what to expect from a service and capacity offering throughout the year ahead here. And have that high level of service expectation, maintain that, because these periods of volatility that we're going to face this year, which I do think will be greater, as we go through these seasonal demand pushes, I'm expecting them all to be relatively short-lived. So you don't want to get yourself in a situation where you're relying on providers that are going to falter when things kind of pick up here, because I think we're going to see more of that as we move forward.
Thank you.
Yeah, I'll just jump in. I think it's a tough time to be pricing as a broker. I think everyone expects the market to go up. But I think at the same time, you're trying to protect margins and manage volumes and take a portfolio approach. It sounds a lot easier said than done, having done that job. And so I think just keeping constant contact on the data sources that you're using, keeping great relationships with your shippers. I think being like super transparent. I think shippers know that something's bound to happen, to what David said. So if they're basically inflexible in a 12-month contracting period, having those conversations up front that say, hey, if the market goes absolutely nuts 6 months into this, we might have to talk to give you the service levels that you need. And I think if you see that conversation from the start and you're awarded business, it's a lot more palatable 6 months in if you have to make an adjustment than just springing it on them. I know personally there's firms that aren't even invited on-prem that have done mid-cycle adjustments in a hasty and sort of non-transparent way. I think from the shipper perspective, the only thing I'd add on top of what David said is just you spent the last couple of years really grooming your routing guides and the vendors that you do business with. And I think this is a year to really take advantage of those strategies. I mean, you've been really getting your house in order the last few years. And I think if what we're all kind of thinking is going to come true, 2026 will be a year to take those new strategies and new routing guides and new processes for a spin. So that would be my overarching sentiment for the year.
I think this could actually be an exciting year because a lot of people have been working to optimize their operations on like the carrier and broker side, bring in, new tech, be able to do more with less. We've also had the shippers, like you just mentioned, really fine tuning their partnerships, preparing for something to change, and nothing really changed. So I think that this could be kind of as an optimistic kind of positive angle on the year as things do change. I think we'll see how efficient we actually prepared ourselves to be through the changes. And hopefully the answer is pretty efficient and pretty optimized.
I can go next and just say more from the carrier standpoint is just still be patient. There's always this desire to call that the market has turned. And I think what all of us feel right now is it's way, way, way too early to conclude that. Certainly wait to see where spot rates head the next couple months before you start to get serious about, okay, we think that rates are higher, we're going to expand. The last thing I'd want anybody to do is get really excited off of a really strong December, get, essentially ahead of their skis, and then find out a couple months later that, hey, this was more a temporary blip. And as Aaron mentioned, we're now adding equipment at an even higher cost structure, and this may have been a suboptimal decision. So just keep watching the market closely, see where things are in February and March. We'll have a much better sense by that point in time where how far out of equilibrium we are.
Yeah, and I can just add a more general kind of comment, I guess, to close it out. I think as economists, as practitioners, we're all constantly trying to navigate between the stories we hear and what the hard data are saying. All basically trying to figure out what is the universal ground truth that is out there. My rule of thumb that has, I think, served me well over the past decade plus is that the anecdotes are usually exaggerated, the data are usually lagging. And so kind of ground truth kind of lies somewhere between the two, extrapolate between those.
That's really good advice, Aaron. That's probably summarizes my last 5 years at attempting to better study freight markets and economics. Trying to find what lies somewhere in the middle, usually of people's thoughts and opinions and data points. So I think anyone would be smart to take that advice into practice. Any other thoughts, gentlemen, before we close out today's episode? No? Okay. I had some written inputs I got via email from Chris Pickett, who was not able to join us today. He was on the previous panel, so I wanted to give him a chance to share his thoughts. But what I did last year that got a lot of good feedback is we took the transcription from this event, kind of summarized it, and released it as the January Truckload Market Update newsletter that I release. So if you guys would like the written version of today, we're going to kind of get some quotes from the guys and some things they shared, and we'll get that out within the next week or so. And so you guys can be looking for that. Just subscribe to the Truckload Market Update newsletter on my LinkedIn. We also have a mailing list. You can message me if you want to add certain emails to that as well to receive that. So we'll have more follow-ups coming from this episode today. A little bit easier to read and digest on your time, kind of work into reports or meetings as needed. All these gentlemen are active on LinkedIn. So if you guys are interested in connecting with them there, that would be probably the best way to do that. They're responsive. They can respond to messages there. You guys can tag them in comments on this live show. If you're watching it back and it's no longer live, tag them in a comment, ask a question. If you had a question come up as you listened to something that they contributed, and I'm sure they'd be able to jump in when their time allows to get back to you there. I think that's everything. Gentlemen, thank you so much. I'm sure I'll see some of you again in 6 months, and we'll see how we did today and how our predictions fell. But thanks, everyone, for being here and for meeting us for coffee today.
Thank you. Happy New Year.
Thanks so much for meeting us for coffee. I'm so excited to be partnered with Watco as our show sponsor. Not only was Watco founded in my home state of Kansas, but the solutions they provide are, in my honest opinion, unmatched. If you have questions about Watco, you can scan this QR code to connect, check out the link in the episode description, or you can shoot me a message on LinkedIn directly, and I'm happy to talk more. If you enjoyed today's show, I'd love if you could leave a rating on your platform of choice. We'll see you next time.